Today, we are diving into a trading methodology that's built on a pretty radical idea. What if the key to the markets wasn't about adding more complexity, but way, way less? We're going to unpack a purely mechanical, rule-based checklist, one that's designed to be so simple, its creator claims a kid could use it. So let's see what's behind that very bold claim. And there it is. This quote from trader Oliver Velez gets right to the heart of the whole approach. He basically argues that kids, because they don't have all the baggage of overthinking and second-guessing, can actually execute a simple plan with way more discipline than most adults. So in this explainer, we're going to walk through that exact plan. All right, here's our roadmap. We'll start with the core idea, then get into the very simple toolkit you'll need. After that, we'll learn how to read the market's mood by identifying 3 basic states. Then, the fun part. We'll pinpoint the exact spots and signals for a trade, learn how to manage it once you're in, and wrap it all up by asking the big question: is simplicity really the ultimate edge? Okay, let's get into the checklist itself. And just a quick heads up, we're simply explaining the methodology as it's presented in the source material. We're not endorsing it or giving any kind of financial advice. You know, the real power of this system, according to the people who use it, is all about what it leaves out. We're talking no news, no company fundamentals, no super complex indicators. The whole point is to avoid that analysis paralysis that gets so many traders stuck, and instead just replace all those opinions with a simple, repeatable process. So if the name of the game is simplicity, what does the toolkit actually look like? Well, as you can probably guess, it's incredibly lean. It really just relies on a couple of specific settings. First things first, you pick your time frame. The 2-minute chart is for those who like it fast. You're in and out of a trade in about 20 minutes. On the other hand, the 5-minute chart is for a more relaxed pace, with trades lasting maybe closer to an hour. It really just comes down to your personality and how long you're comfortable being in the market. And here's what they call the sweet spot. The system suggests that no matter which time frame you choose, the perfect trade duration is somewhere between 8 and 12 price bars. This gives you a really clear and predictable window for how long you should expect to be in any given trade. Now, on top of those charts, you're only going to place 2 permanent indicators, the 20-period and the 200-period moving averages. Just think of these as smooth lines that show you the average price. Their only job is to cut through the noise. And believe it or not, they form the foundation for everything else we're about to talk about. Okay, you'll want to pay close attention here because this is the absolute pillar of this entire methodology. The core idea is that every single market in the world, whether it's stocks, crypto, whatever, it's always cycling through just 3 distinct states. And this shows the flow perfectly. Think of the market like a coiled spring. It tightens up in this quiet, narrow state. Then it explodes outward, trending, until it gets really stretched out. That's the wide state. And what happens when an elastic band gets stretched too far? It snaps back. The market eventually returns to that narrow state to rest and coil up again. It's just a constant cycle. So how do you actually see these states? It's incredibly simple. You just look at your 2 moving averages. When that 20 and 200 are kind of squished together and flat, you're in a narrow state. The market's taking a breather. When they're spread really far apart, you're in a wide state. The market is exhausted. That's it. It's just a quick visual check. All right, so now that we can identify the market's mood, we can get to the most important part, knowing exactly where and when to pull the trigger. So that's the million-dollar question, right? If the market is always moving between these different states, where are the highest probability spots to actually enter a trade? And the answer, according to the system, is 2. Not 1, not 3, just 2. The whole methodology is built on a principle called 2, not 3. Which argues that by just getting rid of all the other options and limiting yourself to only the 2 best choices, you massively increase your ability to act without hesitating. So here they are, the 2 perfect spots. Spot number 1, which is considered the absolute best place to trade, is catching that initial explosion out of the coiled, narrow state. You're trying to ride the wave as it moves toward wide. The second best spot is the opposite. You trade the reversal from a wide state, making a bet that the overstretched market is about to snap back toward narrow. But you don't just jump in whenever you see one of these spots. You need a specific trigger event. And the system watches for 3 of them. First, you have elephant bars. Just picture a huge price bar that completely dwarfs everything else around it. Second, you have tails, which are those long wicks on a candle that show the market tried to go one way, got rejected, and is now heading in the other direction. And third, a simple color change, where one candle's color flips the color of the one before it, signaling a potential shift in momentum. And to add a little bit of data to this, the source material claims that when an elephant bar shows up, there's over an 80% chance that the very next move will be in the same direction. So when you see one of those in a perfect spot, it's considered a really, really high probability signal. Look, getting into a trade is really only half the battle. According to this methodology, what separates the amateurs from the pros is how they manage the trade once they're in it. To protect your position, the system uses a trailing stop, which is just an order that automatically moves in your favor as the trade becomes more profitable. And there are 3 simple ways to do it. The big bar stop is just placing your protection right below a big, powerful bar. The bar by bar stop is a bit more aggressive. You move your stop up under every single new candle, which is great when the price is moving really fast. And finally, the moving average stop is more patient, where you just let the 8 or 20 moving average act as your guide. And just as important, you need rules for taking your profits off the table. The 2 to 3 push rule suggests you cash out after the market has made 2 or 3 obvious surges in your direction. The new high/low rule basically says once the price breaks a recent peak, you've earned the right to take some money. Or you can go with the most hands-off option, just let your trailing stop automatically take you out of the trade for a profit. The whole key here is to remove the guesswork. So let's kind of zoom out and bring this all together and really reflect on the big idea that's running through this whole system. What we really just walked through is a purely visual, almost robotic checklist. You identify the state, you wait for one of 2 spots, you look for one of 3 signals, and then you manage the trade with one of 3 rules. It's a completely closed system that's designed from the ground up to filter out all of that outside noise. And that leaves us with a really fascinating question to think about. I mean, we live in an age of total information overload, where we're constantly told that more data, more analysis, that's what leads to better decisions. But what if the opposite is true? In a world this complex, maybe the real advantage isn't found in knowing more, but in having the discipline to just follow a very simple plan.